Hello and welcome to Fidelity Connects. I'm Agnes Doherty. Brookfield Real Estate is a global leader in property investment and management. With a diverse portfolio spanning residential, office, and retail sectors worldwide, Brookfield Real Estate remains at the forefront of industry innovation. And our next guest is at the helm of this dynamic business. As CEO, Brian Kingston oversees investments, operations, and the expansion of the real estate business. Under his leadership, Brookfield has conducted a wide range of mergers and acquisitions, further strengthening its global presence. I am pleased to be joined today by Brian Kingston, Chief Executive Officer of Brookfield's real estate business, for our third installment of our conversation with CEOs, for a look at how he's navigating the complexities of today's real estate market and his vision for the future of the industry. Welcome, Brian. Thanks so much for joining us today.
Hi, Agnes. Thank you for having me today.
So many of our viewers on the line may be familiar with Brookfield and its global pedigree, but tell us a little bit more about the scale and the scope of its real estate business.
Sure. So, I think you did a good job in your introduction, but as many of your viewers would know, Brookfield is a global asset manager with over $1 trillion of assets under management. Real estate is our largest business, so about $270 billion of that $1 trillion is our real estate platform, and it's a global business. We're in 30 countries. We have over 30,000 operating personnel, boots on the ground in each of these countries where we are operating, and so we're vertically integrated. And so whether we're leasing office buildings in Toronto or industrial warehouses in China, these are all full-scale operating businesses in each of those countries, and it really creates a quite a unique advantage for a number of reasons. One, the scale of our business really allows us to pursue and execute transactions that many others may not be able to because of the size of them. Having that operating personnel just gives us unparalleled information into what's happening real time. So we're not relying on statistics getting published, et cetera, but we're actually seeing what's happening day to day on the ground, and that really helps inform our investment decisions. And three, and really importantly, because we do control all the operations, it allows us to adjust business plans as necessary, because market conditions, can often change, and we're seeing that today with a lot of volatility, et cetera. And so having a full-scale operating platform like that really allows us to pivot and adjust and focus our efforts depending on what we're seeing day to day.
Interesting, and we will talk a little bit more about some of the volatility and our outlook for markets. But first, I just wanted to touch on the strategic agreement between Fidelity and Brookfield. So this was announced back in 2023. Can you tell us a little bit more about the impetus for that and what excites you about this opportunity?
Yeah, so you're right. In August of 2023, Brookfield and Fidelity signed a strategic agreement, that really brought together the best of both organizations, and I think it's a really unique partnership in that sense, because as I mentioned, Brookfield is best in class in operating and managing real estate. Fidelity is best in class in managing funds and in particular with public equities. On behalf of investors and retirees around the world. And so really by combining those two things together, we think we've created a really unique product where these investors can have exposure to both the Brookfield expertise, but also what Fidelity brings to bear. And so the focus really has been on Canadian real estate, and I think that is a really unique moment right now in terms of the investment opportunity, and we've been able to really launch that over the last couple of years, 18 months or so that we've been at it. It's been quite an exciting run, but I think it's only getting better.
So let's talk about real estate as an asset class. Let's talk a little bit about the backdrop. There's obviously been a lot of events that have occurred over the last number of years, from COVID to changes in monetary policy, and today we're facing tariffs and geopolitical risks. So maybe you can start with Canada. What is your outlook for the commercial real estate market today? And maybe then we can also talk a little bit about future state and future opportunities.
Yeah, you're certainly right. I think the last 5 years feels like about 500 years in terms of cycles and the number of events that we've seen. And I think it's important when thinking about real estate and investing in it. There's really two things that drive outcomes. One is what we refer to as the real estate fundamentals, and so that is, what are rents growing? Is your occupancy high? And are your buildings staying full? And then separate from that is the macro. So how much, where interest rates are, what alternative investments, maybe are returning, and the broader macroeconomic conditions. And so over the last couple of years, despite a lot of negative headlines about real estate, and there has been some strong headwinds there, the fundamentals have actually remained really strong. So that hasn't been the issue. Oftentimes in a real estate downturn, the real estate fundamentals deteriorate because too much supply gets brought on at the wrong time, and the economy slows down, and so as an owner, you're dealing with a lot of vacant space or a supply-demand imbalance. We have not seen that. In fact, it's the opposite. Occupancies have remained very high. Rental growth has been very high in most of the asset classes that we're investing in throughout this period of time. What has happened is obviously interest rates as a result of higher inflation have changed dramatically over the last couple of years, and so that's had an impact on the value of some real estate. And so for real estate that is able to pass on the impacts of those higher costs of inflation or higher interest rate, the values have kept up with those changes in interest rates. And for certain asset classes where you're not able to grow rents in line with the increase in your costs, the values naturally have come down. And so that's really created almost a two-speed investment environment for real estate, where high quality, good real estate has performed well, whereas lower quality there's been a real divergence in its performance. And so, as we sit today, the good news is that the changes in interest rates have stabilized. In fact, they've stopped going up, and in some places, particularly in Canada, they've begun to come back down again. And the underlying fundamentals of the real estate continue to be strong. So I think that's a very positive outlook after a pretty volatile couple of years for real estate.
It seems like a great example of how having boots on the ground really makes a difference and allows you to identify opportunities that when you just look at the macro picture, you would have otherwise not really been able to see. Is that a fair statement?
No, that's exactly right. And I think the being able to react in real time and be able to distinguish between broad macro themes and the actual on the ground investment opportunities. And so we always say, real estate is about location, and it's a very local business. And so while we can make a lot of broad comments about is real estate going up or down this year, there's a lot of very local factors that matter, whether that's employment growth in a particular market or supply growth within a particular city. And so having teams on the ground that are operating in that business every day, that are speaking to partners, neighbors, competitors, et cetera, and really understanding tenant outlook for demand, et cetera, it really allows us to adjust our strategy much more quickly than simply looking at macro trends.
Can we sort of compare what you're seeing in the Canadian market versus what you're seeing globally? How do those markets look, or look the same or look different?
Yeah, it's there's quite a variance in performance in markets and in Canada versus around the world. I think Canada and the U.S. have had a pretty robust economic growth over the last couple of years. I think there are some headwinds that are unique to the Canadian economy that we don't necessarily see for the United States, but overall, Canada enjoys very, very favorable demographics. It has a good trade balance. Interest rates are relatively low compared to other major economies, and so and employment has remained high up until now. And so that has certainly provided a good backdrop. And obviously with the increase in immigration over the last couple of years, pros and cons, but one of the pros of that has been a tremendous amount of demand for real estate, and particularly for housing. And so that's really put a strong underpinning below the performance of really anything related to housing, whether it's it's homes itself or logistics that are holding some of the supplies to build those homes. Other economies like Europe really have been more challenged from a demographic perspective. Rates are a little bit lower there, but growth is much slower as well. And so, we really do think the Canadian economy has been a great performer over the last couple of years.
Now, I would be remiss not to ask about tariffs and the geopolitical tensions that we're experiencing. Obviously, a lot of uncertainty and a lot of unknowns at the moment, but how does this tariff talk impact your business?
You're right. It is difficult to predict, and it's even difficult to predict from day to day. I think what's important to remember with real estate is these are very long-term, illiquid investments that we are making, and so for that reason, we try to look through short-term disruptions and short-term uncertainty, and oftentimes that uncertainty or those disruptions can create investment opportunities through volatility and as Warren Buffett likes to say, be greedy when others are fearful. So many times this volatility can create interesting buying opportunities. And if you have the right business plan and you have long-term patient capital and you bought the right assets and sort of execute well on your business plan, we're holding these assets for 5, 10, 15 years from now, and this short-term volatility will dissipate. So we're certainly watching it, taking it into account on around near-term assumptions that are going into leasing, and obviously some of this volatility may have some impact on growth, on consumer confidence, on business confidence, and those are all important things. But as I said, I think they can sometimes create opportunities as well.
So we talked a little bit about current state, and you mentioned several times that you're focused on longer term investments. So as you sort of look out onto the horizon, what are you seeing over a longer period of time for the real estate market?
I think we've gone through a period of time over the last 10 years where interest rates were exceptionally low, and now we're beginning to adjust to an environment where interest rates are higher than they have been over the near term, but certainly in historic standards, still relatively low. And I think as we look forward and think about the opportunities, that's probably the environment that we're in for some period of time. There's a tremendous amount of capital that is required for things like build out of artificial intelligence networks and the associated power generation, et cetera, that goes with it. These are all tremendously capital intensive, and so they will continue to put upward pressure on interest rates. So I think it would be a mistake to make investment decisions on the assumption that we are going back to a zero interest rate environment, and more likely it is in one more like what we see today. And so what that means is cash yield and growing cash yields, or an ability to have your income on the real estate grow along with inflation is really important. And so that lends us leads us toward asset classes like multifamily residential, where the rents are generally 12 months, and then the rents can reset each year. And so it allows you to capture some of that inflationary growth. It also means a lot of this build out is going to lead to a lot more manufacturing and economic activity. And so sectors like industrial warehouses and logistics, we think, they've had a really good run for the last decade as a result of e-commerce, and that growth will continue. But we also think this manufacturing build out is going to lead to more demand, as will the reorientation of global supply chains. And so people will hold more inventory in different locations. So generally anything related to housing or logistics and warehouses, we think has quite a strong demand profile behind it. And that's really where a lot of our investment efforts are focused today.
So I'd like to talk a little bit about the fund that you're managing for Fidelity. So it is a sleeve in some of our global asset allocation products, and it will be a material portion of the new Fidelity Alternative Real Estate Trust. So can you tell us a little bit more about what the specific focus of that investment mandate will be?
So the focus is obviously on Canadian real estate, and trying to, as I would like to say, we're trying to buy high quality real estate on a value basis, and then leverage our operating capabilities to drive above market rental growth in those assets. And so how does that work? Well, we try to find situations where perhaps an owner of real estate is in a situation where they're being forced to sell at an inopportune time, or where there's less capital around, and so oftentimes you can find beneficial pricing that way, or sometimes through more complicated transactions, et cetera, or just being well connected and in the right place at the right time. But in general, trying to source assets on a value basis. And then, as I say, we really try to leverage all of our operating capabilities to execute a business plan that's maybe a little bit different than others would, whether it's increasing occupancy when we're concerned about the future, or pushing on rents if we see a more favorable backdrop, and using that intelligence to do that. And we are strong believers in owning only the highest quality real estate, because as I say, we're going to own this over very long periods of time. Inevitably, in the lifetime of this vehicle, or in the lifetime of these investments, the economy will go up and the economy will go down. And we know that from time to time there's the economies go through recessions or slowdowns. And so if you own high quality real estate, you have it financed in a conservative way, you're able to ride through those down cycles and really take advantage of them. And so what we're really doing here is building an all-weather portfolio.
Maybe you can tell us a little bit more. So you've been working closely with portfolio managers at Fidelity, so David Wolf and David Tulk on the global asset allocation team, and then Don Newman, who will be a portfolio manager on the new alternative real estate trust fund. So tell us a little bit more about your working partnership with them.
It's been a great partnership so far. We have regular calls with the team to keep them informed of the pipeline that we're seeing, and so it's quite an iterative process back and forth with the portfolio managers, making sure that they understand the types of investments and the opportunities, and that they benefit from the intelligence that we're able to gather from our operating teams and inform our investment decisions. And so we've been working closely side by side with them, and have made really great progress in building out that portfolio in a fairly volatile market over the last year.
So maybe let's go there for a little bit and talk about the investment opportunities that you were able to capitalize on in 2024. Can you tell us a little bit more about those?
So the investments, and we were quite active in 2024, and I would say all of the investments fit in with exactly the themes that you and I have been speaking about today. So 6 investments made so far, and a 7th one that's under contract, but will be closing shortly. Three of the assets that we acquired were logistics warehouses in Montreal and Toronto. So in major markets, these are infill locations, critical infrastructure to the businesses that are leasing that space. Each transaction has a bit of a story to it, and so we were able to acquire these on an off-market basis. So we weren't in an auction where we were bidding against a number of other parties, but we're able to negotiate a very favorable price. In part because we were able to move quickly because of the Fidelity Brookfield partnership, but it allows for us to do that. And as I say, in part because we were on the ground. 3 more of the investments are in multifamily residential in Toronto and Vancouver. Again, 2 very strong housing markets, from a renter demand as well as an underlying real estate price perspective. The one in Vancouver, brand new asset, newly constructed, very, very, very high quality. Again, an off-market opportunity to acquire an asset and really utilize our operating capabilities to get it leased up very quickly. And so a difficult market Vancouver is to acquire or to develop develop assets in. So this was quite a unique opportunity and a great buying opportunity for us. And then the 2 in Toronto are older vintage assets that will really benefit from some reinvestment in the apartments to fix them up, and we think that they will, as a result of that, benefit from rental growth. So really happy with how the portfolio has built out. The 7th asset, which has not yet closed, is a brand new student housing apartment building at University of Western Ontario. Very high quality asset in a high demand market, and so again, each of these are in very sound markets, great locations, and we think over the long period the returns are going to be excellent.
It sounds like as well some of these areas not really impacted by a lot of the noise that's happening on the macro side, right? Going back to that point of the boots on the ground and finding opportunities that can kind of weather some of the macro factors or inflation or higher rates or whatever on the macro side of things. So I think it sounds like those are good examples of that.
You're exactly right. I think tariffs or no tariffs, people need to live somewhere, and so having housing assets or student housing where particularly at schools like Western that are in high demand that are always short on supply of housing allows you to really weather some of the shorter term impacts of things like tariffs or interest rate changes.
Now, you mentioned doing a deal or several deals that were off market, and I think that sort of speaks to the Fidelity Brookfield competitive advantage in executing on some of these deals. So can you tell us a little bit more about how those come to fruition and the advantage that we do have?
I think it's a combination of the reputation of the two firms, so that when we are talking to owners of real estate who are maybe considering selling, they know who Brookfield is, they know who Fidelity is, and by reputation, they know that if we say we're going to do something, that we will do something. So that gives them a lot of confidence in dealing with us. But also having access to large pools of capital means that we can move quickly and have creative solutions for owners, so that they don't feel that they need to go far and wide, because they understand that this is probably a pretty unique situation for them in terms of working with us. So I think it's been a huge advantage to have capital available, ready to be deployed at a time when it's more scarce, and it's created some really great opportunities, and I think it will continue to do that. We have a very robust pipeline of other transactions very similar to these that we're looking at now, and having that capital available is what allows us to do that.
So Brian, we launched the Fidelity Alternative Real Estate Trust Fund yesterday, and I wanted to ask, for investors that are considering adding real estate to their portfolio at this point in time, what would you say to them?
Well, Agnes, that's a question we get quite often, and we always try to remind investors of the role that real estate is intended to play in their portfolio, which is as a long-term hedge against inflation. And so while there is a lot of volatility in markets today, whether it's equity markets or bond markets, and a lot of discussion around inflation, real estate really can play a bit of a stabilizer role within portfolios, because it does provide that long-term predictable cash flows that we talked about, as well as an exposure to inflation should we see that in the future. And I think that today, with the added benefit of having a little bit of volatility in the market, that's creating some buying opportunities, or some opportunities to buy things maybe for a little bit below fair value. The opportunity to outperform, with real estate is there today. And so we think as long as you're choosing the right asset classes and you're investing in the right markets, as we've talked about today, major markets in Canada and in asset classes that are resilient and can withstand some overall economic volatility. So in short, we think it is a very good time to be considering to add real estate to your portfolio, given that prices have come down in some asset classes 10, 20, 30% over the last couple of years. And so it's a pretty unique opportunity to enter on a value basis at a time when stability has never been more valuable.
Sounds like a pretty compelling opportunity right now, and especially when you've got two incredible global brands coming together, Fidelity and Brookfield, in the strategic agreement. So very interesting for investors to consider. Brian, thank you so much for speaking with our advisors today. We really appreciate you taking the time.
Great. Thank you for having me.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor. or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.